In 1992, one man made $1 billion in a single day. Not by inventing a product, not by launching a company, but by betting against the British pound. It became one of the most iconic trades in financial history, a moment when courage, strategy, and timing collided. But behind the headlines of "the man who broke the Bank of England," there's a deeper story, one about psychology, economics, and the power of conviction. That man was George Soros. To understand Soros's bet, we must go back to the early 1990s. At the time, the United Kingdom was part of the ERM, the exchange rate mechanism, a system designed to keep European currencies stable as they moved toward a possible shared currency. The British pound was pegged to the German mark, meaning it had to stay within a fixed price range. But there was a problem. Britain's economy was weak, inflation was high, interest rates were already painful for consumers. Meanwhile, Germany had raised rates to control inflation caused by reunification, creating a gap between the two economies. To maintain the peg, the UK needed to match Germany's high interest rates. But doing so would slow the British economy even further. This imbalance was unsustainable, and Soros saw it clearly. Soros believed the pound was overvalued and that the UK government would be forced to abandon its currency peg. Through his hedge fund, the Quantum Fund, he began building a massive short position, borrowing billions of pounds and selling them on the market. Then came September 16, 1992, now called Black Wednesday. As pressure mounted, traders around the world started following Soros's lead. The Bank of England fought back. It spent billions trying to buy its own currency. It raised interest rates twice in the same day. It tried everything to defend the pound. But the market was stronger. Hours later, the UK government finally gave up. The pound was allowed to float freely and immediately collapsed in value. Soros's bet paid off. He made $1 billion in a single day. And his reputation as one of the greatest macro investors in history was sealed. But Soros's true genius wasn't just the trade. It was his philosophy, something he called reflexivity. Reflexivity is the idea that markets don't just reflect reality. They help create it. When people panic, they push prices down. When they get overly excited, they push prices up. In other words, perception shapes economic outcomes. Soros believed that understanding this feedback loop between market psychology and market fundamentals was the key to anticipating major turning points. And Black Wednesday was the perfect example. Traders lost confidence in the pound. That loss of confidence led to selling. That selling made the collapse inevitable. It was psychology turning into economic reality. Markets are driven by data and by people. Both matter. At Castillo Investments, we follow that same principle. We analyze fundamentals, earnings, and balance sheets, but we also study behavior, sentiment, and momentum. Because numbers tell you what has happened, but psychology helps you understand what may happen next. Soros' story reminds us that the greatest investors don't just react to markets. They understand their patterns, recognize when something is unsustainable, and act with discipline and conviction. Visit elcastilloinvestments.com to learn more and follow us for more financial insights.